In this session, let's look at the computation aspects of the various market indices like Sensex. The mechanism which each of these indexes like Sensex or Dow Jones or Nasdaq or typically the various indexes that are available in the world. What are the various forms of calculations do they resort to? And to create a new index, what are the various points that need to be considered, right? That's a typical thing. And what are the most common kind of indexes that are available is what is being covered as a part of this chapter. Yeah, just moving forward. Index is always, even when we look at Sensex also, or for that matter Nifty or anything, it talks about the performance of the complete asset class or a market itself. See, whenever we have to say the markets are down or the market is up, we always use Sensex as a proxy for that, or we always use Nifty as a proxy for that, saying the markets are down. Actually Nifty is down, but we say the stock markets have fallen. The most common word. Or when I ask anyone, what do you mean by stock market has fallen? The first thing that comes out from his statement is Sensex has fallen or Nifty has fallen. So the index has such kind of a power. Any index that is created, the main intention is it's a representative of a market or even a segment of a market. We have not just the Sensex or Nifty. Today we have auto index, we have IT index, we have media index, we have different kinds of indexes, banking index. So those indexes are a reflection of that particular sector. So in general, whenever we talk about any index, it's a reflection of either the whole asset class. So we have some bond indexes, we have some commodity indexes, we have indexes across the various markets and sectors. But they are like sum total of the various individual securities put together in with some kind of a formula, so that it reflects that entire group of securities, or it reflects the entire market as a whole. And whenever we talk about performance, we always try to measure it with respect to that particular index. Sometimes for the mutual fund managers or for any such kind of investors, right, or fund managers typically, or portfolio managers, their performance is always compared against the index as the benchmark. Okay, in this year Sensex has grown by 12%. So your portfolio has grown up by how much? 8, 10, 15. It's always compared against that particular index value. So if you have generated a return which is more than the index return, we say that the portfolio manager has exceeded the expectation. So as a mechanism of expectation, the Sensex or Nifty, or for that matter any index, is taken as a benchmark. So that has so many such kind of advantages associated. Then when we are talking about indexes, there are two broad categories of indexes. One is purely based on the prices of the securities. By taking the prices of the securities only, the index is computed. The other is total returns. We hardly see these kind of indexes today, but they look at both the price as well as the returns like dividends. So the total return which an investor is getting, the total return index is more focusing not just on the price but also on the income, which is the constant inflows that are being coming in the middle. Whereas when we say the price index, it's purely the return is computed purely based on the price of the security. And These are some of the things that are typically considered when you are coming up with a new index. Which market you would like to measure? See, today we have so many indexes already, right? Probably if I look at, you see on BSc, already you have these many. See, the prime indexes wise, you have a Sensex, you have a mid cap index, you have a small cap index, composing of small stock companies, large cap companies, Sensex, mid cap companies, middle range companies only put together, or BSc 100, which is top 100 companies. Probably there could be some from here, some from here. All these could still be there as a part of 100. Similarly 200, similarly 500. So probably top 500 companies are included here, though that there are almost 5,000 companies which are listed on BSc. So out of that, top 500 companies are being included as a part of BSc 500. Similarly, you also have large number of sectoral indexes. Like you see here, consumer durables, healthcare, banking. Now, if you have to create a new index, you have to see what is that you really want to measure. Probably any industry that is not covered. Probably you may say, yeah, I'll look at the financial services, non-banking financial services kind of index, right? Which is not there. Only a banking index is there, but non-banking financial services index is not there. So you may say, I will track that kind of an index. I'll create such kind of an index. So because I am seeing that there are so many companies in the non-banking financial services, but there is no specific index exclusively for them. So I want to create one such kind of an index and I want to start tracking that. So that's so in that, then the next thing is which securities will you include? What is non-banking financial services? Which all companies I should include, right? Should I include some kind of uh, transport finance kind of companies? Should I include some kind of housing finance companies? Or how much proportion of each kind of companies I need to, or gold finance companies? What kind of companies I have to include as a part of non-banking financial services? What kind of companies I would like to include? How much weightage I want to give to each of the companies? Then I should also look at the rebalancing mechanism. Like, okay, how much weightage, and probably as the time progresses, I should be able to change the weights also. Now I have given 10%, let's say, to India Bulls. But if it is not performing well, tomorrow I should bring down the weightage of it to some 7% or something. So what is the frequency at which I will evaluate the various securities in terms of inclusion as well as exclusion? If you see Sensex, the same 30 companies will not be there forever. Every quarter they will review and they will come out with which companies need to be removed and which companies need to be included. If we see here, okay, you will see that index, okay, somewhere you will find where they, I mean, what is the frequency at which they change, and what are the companies that are changed pretty recently. Script wise weightage. Okay, let me look at it. Okay, these are the percentages right now which they are giving. ITC, they have given 10.76% weightage. In the computation, Infosys is given 9.5, Reliance Industries is given 9.55. These are the weightages they have given, which means the 30th, probably towards the end, GAIL India is given only 0.94% weightage, or probably Coal India is given only 1% weightage. So different companies are given different weightages. And what we also see is, when this I mean, they'll always maintain a report of, probably let me see, it is easily available in NSE. Yeah, at least here. You see here, list of stocks, index maintenance, details of past changes to Nifty. So what you typically see here is, you see here the latest is here on 1st April they have reviewed it. They have removed Siemens from the Nifty 50. They have included IndusInd Bank. They have removed Wipro. They have included NMDC. Similarly, last year, so I mean, though they are meeting up every quarter, but the major changes are coming every 6 months. So probably there is a possibility that you can expect one more in October. In October, probably you may see that one or two companies may move out and one or two companies may come into the inclusion of the Sensex. You are seeing here also on this day they have met. They have removed SAIL and included Lupin. They have included Sterlite Industries, and they have included Ultratech Cement. Like that, if you see, probably the same company might have gone this side also. All would have happened. At some point, Dr. Reddy's got included only in 2010. But it got excluded in 2008. So it's not that once it is excluded, it cannot come in or something like that. It got excluded here, it again came back here. Right? Like that, you will find a lot of companies even operating in that kind of a manner also. The same thing you will see with respect to Nifty Junior, which is the next 50 kind of stuff. You see, these are excluded, these are included. This is very old. Probably the latest is here. So what they are saying, okay, they have included United Breweries, but they have removed Torrent Power. Like that, you could see some of them moving out, some of them moving in at regular intervals of time. So that is one more thing that has to be clear as a part of the rebalancing the strategy and re-examining the selection as well as the weights. Rebalancing is changing the weightages, and re-examining is removing as well as re-adding some other companies to the portfolio or to the list. Now, the calculation wise, we see that there are typically three major types of calculations that are done as a part of the index constitution kind of a mechanism. Right? What I can typically see is, I'll put up a calculation straightforward. Let's say I want to include three companies A, B, C in the index. I'm talking of only three companies, A, B, C, right? Out of these three companies, let's say A is trading at 100 rupees a share, B is at 10 rupees a share, C is at 1 rupee a share, right? And okay, this is called as share price. And let's say there are the total number of shares which are there for each of them. Let me assume that there are 100 shares of this in the market. Then there are 2000 shares of this in the market, and let's say there are 10,000 or 10,000 shares of this in the market. Let's say these are the number of shares that are available. Now there are three different mechanisms of computing the indexes that are there. One we call as a price based index. So where the index is computed purely on the price, irrespective of the number of shares. They don't look at the number of shares. They only look at the current market price and an index is computed. So whenever we say price index, price based index, it starts like this. Today, let's say I'm starting the index today, right? I've started a fresh price based index today. And I am saying my index will contain only these three companies to make it things simple. Now what we are saying is I'll take the simple average of these three prices, and that is what will be the starting index. So probably the average of these three, which I am planning to include, the average of these three is my starting days index. 37 is my starting days index, right? Whereas, okay, now the next day, now I'll say day 2 after the index is formed. Let's say this price has gone to 102, this has gone to 12, and this has gone to 2. The shares, the price has increased. Now the index also gets increased accordingly, which is nothing but probably the average is again taken on day 2. The index is becoming 38.66. This is the price based index mechanism. Very easy to calculate, right? Today, very few indexes across the world follow this mechanism. The most common being Dow Jones, probably one of the oldest indexes in the stock market history. They are still following this kind of mechanism itself, whereas many other stock indexes, they use what is called as a market capitalization based index, which we'll deal with next, but we'll complete the price based index. So the major index which is going with the price based index is the Dow Jones, and even Nikkei also follows this price based kind of an index itself. But here the problem comes when there is a stock split. When there is a stock split, right, the price will actually come down. Okay, now here let's say there was a stock split. So I'm saying after the stock split, let's say it has gone to 52. Actually the split will take it to 51, and some trading happened and it has gone to 52, and let's say this has gone to 11, and let me assume that this has gone to 1.8. Now if I take a simple average today, the index is becoming 21.6. Then a simple sudden news comes out, or probably I'll make this 12.5, slightly improve. This I'll make it 2.2. So logically speaking, actually all the stocks have gone up. This has gone to 12.5 from 12. This has gone to 2.2 from 2. This has actually gone to 104. So all of them have actually gone up. but my index is showing that it has gone down, because index is a reflection of the market. Now the meaning is completely changing. When all the shares are going up in price, I cannot have index go down in value. So whenever there is a stock split, what is typically done is, in case of price weighted index, whenever there is a stock split occurring, we adjust the divisor. Right? What do we do as a part of adjusting the divisor? What we'll say is, okay, this is breaking into two pieces. So what we say is, any of these stock split or any of these corporate actions, not the performance action. See, the index should go down only because of performance, not because of corporate actions. Right? So what it says is, any kind of corporate actions that are coming up, before the action versus after the action, the index should remain the same. What does that mean? For that, what I will do is, I will assume that this is 51 only. I will not assume this as 102. Assuming immediately the stock is splitting, I will assume this as 51. 51 plus 12 plus 2. How much is it? 65. What I will say is, 65 plus x, or probably 65 divided by some x, should still be equal to 38.66 only. Getting this? Before, see, the index here is 38.66. Right? Just a corporate split, just a stock split should not change the index at all. So even after I make this 51, which is a split, even after I split this stock, the index should be still 38.66 only. So adjust the divisor accordingly. Don't divide by 3 anymore. When I say average, I am adding that whole thing and dividing by 3. Now what we are saying is, don't divide by 3. You change the divisor in such a way that the answer is still 36.66 only, 38.66, sorry. That this is still 38.66 only. So which means, what is your x coming out to? X is coming out to 65 divided by 38.66. So probably it is coming out to 1.68. Now what we are saying is, these three numbers, whatever are the new, divide by 1.68 to come out with the index, not with 3. When we have taken the average, we are dividing these, summing these 3 and dividing by 3. Now we will not divide by 3, we will divide this by 1.68. This is the new divisor. Right? Which is making, before the corporate action and after the corporate action, I am not changing the index at all. Just before, just after. So if I immediately split it, this would have become 51. Right? 51 plus 12 plus 2 divided by something else should be still equal to 38.66. So that's what, by what it should be divided is what we are deciding here, which will equate both the values. So now from here, what I will do, from today onwards, the index will be computed based on the sum of these 3 divided by this. So the index is 39.67. It's consistent. Because the 3 securities have grown in some form or the other, even the index has shown some kind of a growth. See, this is happening on a day-to-day basis, right? Now, today it is 39. Now, let's say, now this is getting split tomorrow. Tomorrow, this is getting split, right? So, let's say if it has to be split, this has to become 6.25, right? So, what will I say now? 52 plus 6.25, 58.25 plus 2.2, 60.45. So, my new divisor now will become 60.45 divided by 30, divided by y equal to some 39.67. So this is my new divisor. If I divide by this, this is my new divisor. So from today onwards, I'll use 1.52. So tomorrow, if this has become, let's say, 51, this has become 6.5, and this has become 2.4. Now here, this will become the summation of these three divided by 1.52. So the divisor is the only thing that keeps changing. So 39.31. So there is a slight fall overall in the index. So this is how any price based. So the price based index, very much care has to be taken, especially whenever there is a stock split kind of corporate action happening, because this model does not take into consideration the number of shares. In case of stock split, actually, though the price comes down, the number of shares will get doubled, right? Because this price weighted index, it does not consider the number of shares at all. I have to manually do the adjustment to the divisor every time, and the same logic will hold true if at all I am removing C and replacing with D. Now let's say, because we are saying that we have to remove, we have to re-examine at regular intervals which companies have to be there in the index and which companies should not be there in the index, right? So let's say I am taking a decision that I will remove C and put D. What it says is, let's say now my intention is remove C and replace it with a D whose stock price is 25. Now let's say I am removing C, replacing it with the D whose stock price is 25. This is also a kind of index manipulated kind of an action. What it says is that also should not change the index. So the new addition again which we are going to come out with, 51 plus 6.5, 57.5 plus 25, 82.5 by some y should be equal to 39.31 only. Even when I am bringing a new company also by replacing the existing, so it should become probably how much? 51, 76, 82.5, right? 82.5 divided by this one. So my new divisor will become again 2.07. The moment I am removing C and including D as a part of the index, my divisor again gets applied to 2.09. Getting it? So, which means even if even if the company is doing a stock split or something like that, it should not impact the index. See, sometimes people say the index has fallen just because there was a stock split or there was something else that has occurred. Those cannot influence the index at all. Similarly, sometimes people say like this only, C is removed and D got added to the index, and that's the reason there was a increase or decrease in the index. Even that will not happen. The index will take utmost care to make sure that the index value is not getting impacted because of the administrative related issues. The index will get impacted only with respect to the performance of the constituent, but not administrative related issues. Whether these are applicable both for all kinds of calculations, but I'm making it as a generalized kind of stuff. Then the next kind of mechanism which we are looking at is market value or market capitalization based index, which is the most common index across the world. What is typically done in this case is, instead of just the price, people consider the market capitalization, which is nothing but the price multiplied by the number of shares. Price multiplied by the number of shares is what is being considered. Right? Now, whatever is the sum, right? Whatever is the sum on the day of starting, let's say today we are starting creating the index. The sum is 40,000. So, they will equate this 40,000 to some 100. I mean, instead of taking the sum as a big number, they'll start with some base number like 100. Generally, the indexes start at 100. So, they take a base number called 100, which means if I divide this 40,000 by 400, it will give me 100. So, initially, the divisor is set at 400. Initially, the divisor is set at 400. So, it's as good as saying today's index is nothing but 40,000 divided by 400, which will give me 100. So, let's say the second day the prices have gone like this. Okay, so what will happen to this thing now? This multiplied by this. These are the numbers. So, this is what has happened to my index. Is that the case? Yeah. That's the 135.5, which means the index has grown by 35%. Right here, the index has grown marginally in a price weighted, whereas here we have seen that the index has grown by 135.5 kind of stuff. Now the same logic, day 3, but the advantage now what we see is, even if there is a stock split, it does not have a big influence. You don't need to do any adjustment in case of the market capitalization based index, because the market capitalization does not change. Even if the price comes down, the number of shares will get doubled. Price becomes half, number of shares will become double. So, obviously no change in the market capitalization. So, if we see here on this day 3, even if it has become 52, number of shares instead of 100, they might have become 200. So, the market capitalization would have been that much. And this one, instead of 12.5, okay, this is what is the market capitalization for this. And in case of this, the market capitalization is this much. So obviously this is becoming 57,400 and this is becoming 143.5. Dividing by 400, it is giving me 143. So market capitalization based indexes, they don't get much of an impact because of the stock split kind of action. But replacements, right? Probably now C is replaced with a D. Now C is being replaced with a D. D is having a share price of 25 with probably, let's say, 500 shares. Right? Then what is its market cap here? 25 into 500. So around 12,500 is the market cap. But I am removing the company with 22,000 market cap. The index should still be the same. Right? Let's say I am removing C and replacing it with D, whose market cap is 12,500. Before and after, the index should still be 143.5 only. What does that mean? 10,400 plus 25,000 plus 12,500 by some X should be equal to 143.5. So what will be my new divisor? My new divisor will not be 400 anymore. My new divisor will be the sum of these two plus 12,500 divided by 143.5, which will come out as, now my new divisor will be 333.79. Right, so which means then here I will replace this with 12,500. Then my index will still be at 143.5. Now from divisor is changing. So from tomorrow onwards, I'll use the new divisor 333.79 to calculate the price, to calculate the index. So the index will change only based on the real price performance, of the individual constituents of it, but not because of any kind of administrative actions. Right? So this is one way. This is the way to decide the market value or market capitalization based index. It is not impacted by the stock splits. You don't need to make any specific adjustments to the divisors for stock split. But when you are reevaluating the constituents of the portfolio of the index, then you have to make the necessary adjustments to it. Then the third kind of index which we are looking at is the equal weighted kind of index. The way it goes with is the day on which you are starting the index, you start with 100. The day on which you are starting the index, you start with 100. And for each day, you will find the percentage increase. You will find the percentage increase in the price. Okay. What is the percentage increase here? 2%. 102 minus 100 divided by 100. You are seeing the percentage increase, 2%. Probably you are finding out the percentage increase of all these things. 2%, 20%, 100%. What it is saying is you find out the average percentage change of all these. 41%. You increase the index also by 41%. You increase the index by 41%. So it becomes 140.67. So for tomorrow, for the next day, again, okay, here you can very well assume as if the split has not occurred, 104. So probably here you may say 104, because it is focusing only on the percentage increase. Or 52 and 51, both you make them to be the same. Either with split or without split, both of them will remain to be the same. From 102 it has become 104. Whereas here from 12.5, from 12 it has become 12.5. Correct? This much percentage is there. And whereas this also from 2, it has become 2.2. So these are the percentages. Now probably I can find out the average percentage increase here. 5% is the average increase. So probably here I'll do into a 5% increase. So for the next day my index is going to become 148.26. So this is the way equal weighted index is typically computed. The difference here is The three are in price weighted index, the weightage is given based on the price. Right? Probably the one which is having high price is given more weightage. The one which is having low price will be given less weightage. In the market cap based index, the weightages are given based on the market capitalization. The one which is having a highest market capitalization will have highest weightage and others will have the least kind of weightage. Whereas in the equal weighted index, the percentage change is given the weightage. The one which has changed drastically from the previous period will get a more weightage compared to the other. That is the reason why we say equal weighted, because we are taking the average of the percentage change across all the three. So that is where we are calling it as a equal weighted kind of a index. So these are the three common kind of indexes that are typically used. So if we just see the price weighted index, it's the arithmetic mean of all the prices. Divisor initially is equal to number of securities. We have divided it by 3. Adjusted for stock split and changes in the composition of the index over time. The divisor gets adjusted every time. Whereas equal weighted, there is no need to adjust the divisors or anything, because we are always talking about the percentage change. Even when I am removing this company and replacing with some other company, all I require is the percentage change from yesterday's to today. Instead of this company, some other company. What is the percentage change in the price? So equal weighted index does not need any kind of adjustments. Whereas when it comes to market capitalization weight, we have already seen the weightages are given based on the market capitalization of all the securities. And we are changing, right? We are changing the divisor according to the change in the constituents, or probably there is also one more thing called free float. Nowadays, most of the indexes are computed based on this concept of free float. See, in the market capitalization, we got these numbers, right? But out of this, some proportion of the shares that is obtained through the number of shares only, some proportion of the shares are never freely traded. Like the shares which are held by the promoters, shares which are held by the government, they are generally not traded so frequently. So they have modified these numbers and they have come out with another definition called free float market capitalization. What is that free float is? What proportion of these shares are freely tradable? So they will remove those shares which are held by the promoters. Those are held by the large government institutions who will not do the trading on a regular basis. Only those shares which can be freely traded in the market, they will find out what proportion of those shares are there which are freely tradable. So the market capitalization is adjusted based on those numbers. Right? So probably for A, 80% of the shares are freely tradable. But for C, only 20% of the shares are freely tradable, because 80% of them are with promoters or government or someone else. Then what we'll say is, instead of writing 10,000 here, we'll write only 2,000 here, because only 20% of them are freely tradable. Similarly, here also we'll make it 8,000 and then do the divisor computation. And what it says is, even at a later point, if this composition changes, probably from 80% it goes down to 70%. Even because of that also my index should not change. So change the divisor at that point. Make sure that if it changes from 80 to 70, the index is not changing. Right? So whether it is a change in the composition or change in the free float percentage, in either of them, the index should not change. So which means the divisor has to be adjusted to accommodate those kind of changes. Then there could be some custom kind of indexes that could be created purely based on the fundamentals of the company, like P by E ratios, price to earnings ratio, or probably the net profit of the company, or based on the revenues. I create my own index. I give weightages based on the revenues of the company. So which are more and more specific, which are more and more specific to the analyst, which are nothing very commonly available in the market. But yeah, you can create your own index to track the performance of the companies, where weights are given not on price, not on market capitalization, not on percentage change in price, but you may give it on the revenues or cash flows or some kind of element from P&L, balance sheet, or cash flow statements of the companies. Then when we talk about the rebalancing aspect, we are more focusing on at what point. We have already talked about the divisors, changing of the divisors as a part of rebalancing or reconstitution. But when it comes to equal weighted index, the rebalancing wise, it hardly matters, right? Because you always find a percentage change. The weightages wise, we are the divisor does not need to be changed, especially for an equal weighted index. Even if the composition is changed, even if I remove one company and replace it with another company, no change is coming as a part of equal weighted index, but there is a huge change that is coming in the divisor for price index as well as for market capitalization kind of index. And when you are talking of reconstitution also, you have to have a proper plan in place, how you remove a security and how you include another new security. Because see, when I am talking about market capitalization, typically the top 50 companies which are having the highest market capitalization, as well as probably across the various industries, I'll try to identify and I'll include them into the index. So probably if on every quarterly basis, will I remove the 50th company and include the 51st company? Or two are removed, two are included? Or probably if the outside company is having a market capitalization more than the inside companies, only then will I remove them? Even if they are belonging to the same industry which is dominated in the Sensex, even then I will include a new company? Or will I choose a company from a different industry altogether? Though it is in the 53rd or 54th position, will I try to include that rather than a 51st company which is representing an industry where there are already 7-8 companies in that industry in the index? These kind of things have to be made clear as a part of reconstitution policy of the index. And any index which we are creating, it should definitely reflect the market sentiment, right? When we say market is up, almost a good number of securities which are a part of that market should show an upward sign. So it should help to evaluate the performance of portfolio managers or some kind of fund managers or investment kind of managers. It's a typical measure of market return. If you remember the CAPM model, right? We said the return on security is risk-free rate of return plus beta times RM minus RM, market return. And when we said market return, it is nothing but the Sensex return itself. And it helped me in determining the beta, right? So these are some of the advantages, and it acts as the base for index funds, right? When I say an index fund, it will mimic either a Sensex or a Nifty. Or when I say ETF, even ETFs will mimic either a Sensex or a Nifty. So there are so many funds which will take this particular index as a base for the performance of those particular funds. Now, the indexes can be across the various securities. There could be equity indexes, there could be bond indexes, there could be commodity indexes, there could be any other alternate investment kind of investors like hedge fund indexes. Across the various sectors, across the various security instrument, you could very well have indexes. Like there could be something apart from whatever we have considered, Sensex, Nifty, which are typically the most common kind of indexes. We can also see multi-market equity indexes, like across the world, probably some countries and some securities from each of the countries. They are going under the multi-market equity indexes. Then you could also see some sector-based indexes, as we have seen banking index, auto index, right, pharma index. They are all considered as a part of your sector-based indexes. You could also have style-based index like mid-cap, large cap, small cap, growth index, value index. These are the typical investment styles. So corresponding to the various styles also, there could be different kinds of indexes. When it comes to bonds or fixed income securities, the indexes could be created on so many scenarios. Strong collateral versus weak collateral kind of indexes, or issuer based, rating based, AAA rated. No, this is fixed income index. Those are equity indexes. These are fixed income purely for bonds, right? I mean, there are so many bonds that are traded in the market. Just like stocks that are traded, there are so many bonds that are traded in the market. Let's say there are 200 government bonds that are traded in the market. So we can say government bond index. They are all issued by government only. So based on the issuer, I can create an index. Based on collaterals, secured bond index versus unsecured bond index, or coupons, zero coupon bond index, 10% coupon bond index, maturities, short-term bonds index, medium-term bond index, long-term bond index. I can have, or probably credit ratings, investment grade bond index, speculation grade bond index, AAA rated bond index, B rated bond index. So I can have different kinds of indexes associated with the fixed income securities. But again, inside that also we can talk about style, sector, all these things can again come into picture. The biggest thing is, in the fixed income, one single company can issue so many bonds. See, in a typical equity market, probably for one single company, there is only one share representation, one share price. But in a bond market, one single company can issue 4 types of bonds or 10 types of bonds. So the number of entries, the universe of the fixed income is much more broader compared to the equity market. And the other biggest problem is, in equity, that company is assumed that it will exist forever. But in case of fixed income securities, once it matures, that bond is taken out of the index. So the reconstitution which we talked about, it will not happen not just on performance, it will happen even because of maturities and some bonds being removed out of the index because it has already matured. So I have to remove that and include something else. So it's a big challenge when it comes to the fixed income kind of securities. And what we also see is, there is a lot of illiquidity associated in the fixed income market today, which means not heavily traded. Even if you see today on the stock market of India, shares are very frequently traded, but bonds are not that frequently traded. So there is some level of illiquidity that is present in those bonds. So all these things have to be considered when we are talking of creating a fixed income kind of an index. Similarly, we have various alternate investment indexes, like for commodities, same like. Even for case of commodities also, I can think of agri commodity index or precious metals kind of index. Now in these also, It may so happen that for some season, some particular commodity will have a very heavy demand, right? The volumes of tradings on some commodity will be very high in some season, whereas it goes very low in some season. So that index also have to be manipulated very comfortably. Remove this at this point, include this, so that, and at all these stages the index should not get impacted because of removing and addition. Similarly for real estate, right? I'm talking of some specific kind of securities to be included as a part of the index. Now if those securities are sold off, then what kind of securities will be included as a part of the, so these are so many challenges. Even in case of hedge funds again, they are not fully regulated. So the index performance purely is based on how the managers report the performance of that hedge fund. Sometimes what could very well happen is, if the fund has not performed well, probably the manager may not report the performance of that fund to the index management guys itself, because there is no stringent requirement in terms of stringent regulation in terms of reporting and all. The fund manager may typically choose not to represent at all. In those kind of cases, there are so many challenges that are existing with respect to alternate investment indexes. But yes, for the tracking of the performance, or for setting a benchmark regarding the performance, it's always advisable to use some kind of a security market index. Come out with a proper mechanism to calculate that security market index, in order to set a benchmark to talk about whether the performance has gone up or gone down. So we have various types again associated with the geographic locations, like country based or global based kind of indexes. We have different indexes catering to sectors, right? We have seen even in our Indian market various sectors based. Then we also have something like emerging market index, where the companies from all the emerging countries like Russia, India, China, Brazil kind of companies are put together, and a new index is formed. Or sometimes it could be based on some of the fundamental factors itself, like the revenues, or EPS, or the growth, the sales growth every year. The indexes are formed based on various dimensions. You can create an index based on your own evaluation of the criteria which you can use for the performance of the particular company.